Hello, this is Beau with Investor Financing Podcast, and we have another great show today. We're going to dive deep on some tax strategy. And a side note, you should always consult your specific CPA or attorney. This is just for educational purposes only. But we have a great guest today. I've been following him for a while, reading articles and just trying to educate myself on tax advantages for real estate professionals and tax advantages for the normal working W-2 employee. There's lots of things you're going to take away from this conversation. Please welcome Thomas Castelli. He's a CPA and a tax strategist, real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's hands. His real-world investing experience combined with his ever-growing arsenal of hard-hitting tax strategies help him see eye to eye with investors in ways an average CPA cannot. Welcome to the show. Thanks for joining us.
Anytime. Thanks for having me. It's an honor to be here. I just want to let everybody know if you're watching this on a video, my laptop screen's broken, which is why I'm at such a weird angle, but happy to be here. Thanks for having me.
Okay. I was wondering that too. I just didn't say anything. I said, okay, well,
yeah.
But anyway, just want to hear a little bit about how you became a CPA and your real estate experience and what led you to that's how I found you originally is you post a lot of good content. You have a podcast. How long have you been doing this? What really got you interested in this space?
Thank you. Way back since I was a child, I was saying I'm going to go into business and, I'm going to be an entrepreneur and all these different types of things. And then kind of throughout high school, everybody, I feel like high school is a funnel for college almost. And I was kind of groomed to go to college. So then I went to college, got a degree in accounting, and kind of in my, it was my junior year in college, so my third year in college, I started getting interested in, okay, well, how do I build wealth? If I go and get this job, I become an accountant, that might make me some money, but how am I actually going to go build real wealth? And then I came across Rich Dad, Poor Dad, which I'm sure many people have. And from there, the rabbit hole goes pretty deep, started looking into real estate, started going to real estate meetups at the local RIA, and eventually met a group that did multifamily syndication. And I went to they had a 3-day seminar where they went through the whole entire process A to Z. So I went to that back in 2014. So that'd be, I guess, 7 years or so now. Might be longer. Time just keeps going. But and from there, I met a group of people who were doing syndicates, and I invested with them as a limited partner. And then from there, I met a mentor through that group who said, if you ever find a deal, bring it to me and we'll syndicate it. So I found a deal, 82-unit apartment complex in Jacksonville. That was back in 2017. And we went full cycle with that deal, open to shut. We closed on the sale of that in May of 2020. It was supposed to be in March, but COVID delayed it. But so we went full cycle on that deal. And that's kind of how I got into real estate investing. But then on the accounting side, I eventually said to myself, this accounting thing, I was in audit and I was like, audit's not really what I want to do, more of a tax kind of guy. And then that's how I met Brandon Hall, the founder of the Real Estate CPA. And I was like, I would love to combine my background as an accountant and my passion for real estate investing together. And that's how I ended up as a tax strategist at the Real Estate CPA. And that's where I'm at now, provide a lot of tax consulting for real estate investors of really all shapes and sizes.
Awesome. Thank you so much for sharing. I'm in the financing business, and so I help a lot of clients. A lot of my clients are right now are buying short-term rentals. So I kind of want to dive into short-term rental space real quick. With short-term rental ownership, there's a potential loophole because you're operating as a business where they can take advantage of this. Similar to, so what I'm seeing, I guess, I want to break down a little bit is my buddy just bought several short-term rental properties, and I understood the concepts that he can do a cost segregation study. He can accelerate the depreciation. There's also some advantages if you're actually operating the business and you're not passive with the business, right? And what determines if you're passive or if you can take advantage of some of maybe the tax benefits?
Right. So for short-term rentals, there is a loophole. So there's kind of two pieces to this. The first part is the average stay is 7 days or less. So you have to have an average stay of 7 days or less on the property. That that turns your rental activity not into a rental. It's just considered a normal business under the tax code when you meet that requirement. When that happens, all you have to do is prove that you materially participated in that business activity, the short-term rental. And there's 7 material participation tests, but as it pertains to short-term rentals, there's really only about 3 that are really going to be relevant. And the first one is that you spend 500 hours on the business. So it's very simple. You spend 500 hours, done. The second one is that you do substantially everything. And that means that you pretty much do everything yourself, meaning you have very little to no outside help. And the third one is you spend more than 100 hours on the activity, and no one other individual spends more time than you. And believe it or not, that third test is the one that most short-term rental investors that I've experienced working with tend to gravitate towards, because getting 500 hours in a year on a short-term rental activity may not always be feasible. It averages out to be about 10 hours per week. But 100 hours, getting more than 100 hours, just making sure that your cleaners, that your contractors, if you're working on them repairs and maintenance, they don't spend more time than you.
Got it. So okay. So that from there, let's say I bought $2 million. I bought 3 properties on the West Coast that are short-term rentals. They're all 7 days and less average stays. So that $2 million in theory, and I'm my day job's either W-2'd or I'm a mortgage broker or whatever. If I go ahead and get a third-party cost segregation study done, I can accelerate the depreciation essentially, and then I can take. Is it year 1, 2, and 3 that you can take the losses, or take the accelerated depreciation rather?
Yep. So the way it works, there's bonus depreciations in place right now, and it's first year bonus depreciation. So what ends up happening is when you run a cost segregation study, that's generally what you're going to do, and anywhere between, in our experience, anywhere between really 20 to 30% of the property's purchase price can be reallocated to 5 and 15-year property. And under the tax code, the 5 and 15-year property is eligible for 100% bonus depreciation, which allows you to take 100% of that expense in the first year. And that usually adds up to be about 20 to 30% of the property's purchase price. And then the remainder would be depreciated with a short-term rental, typically over 39 years.
I'm speaking to one of my relatives right now, who's W-2'd, crushes it as a W-2.
Right.
But he's got no write-offs really. I mean, other than the mortgage, interest, primary residence. And I keep on trying to tell him, listen, you should get the Airbnb business going. You could use it sometimes, right? But you can also run this business, and for him, his wife doesn't work, so it'd probably be easier to have her run the operations of the business anyways, and that she spends that certain amount of time in the business, the hours to qualify. But essentially, so when you accelerate the depreciation, let's say 5 years later, I want to sell the property. How does the recapture portion work?
Right. That's a good question. So when let's just say, for example, right, you have $100,000 property and you buy it and you do 100%, you buy it, you do a cost segregation study, and you get 25% of its value is allocated to 5 and 15-year property. So if it's 25%, that's going to be $25,000. Now let's say that fast forward 5 years and the property is worth $150,000. So you have a $50,000 gain from appreciation. So that's, you bought it for 100, it appreciated 150. But then let's just say you took $25,000 of appreciation. That's all you took over that time. It's not possible, but for the sake of this example, you took $25,000 of appreciation. You're going to have another $25,000 gain from the depreciation you took, and that's called depreciation recapture. Now, the way that depreciation recapture is going to be taxed is you're going to pay taxes at the ordinary income rates on the 5-year property. So your ordinary income rates go from 0 to 37%. So let's just say out of that $25,000 you took on first year bonus depreciation, $15,000 of that was 5-year property. You're going to pay tax on that $15,000. That's your ordinary income rates. The part from land improvements, that's going to be generally taxed at a maximum rate of 25%. So that's kind of how the depreciation recapture works. It just depends on the classification of the depreciation recapture. And the 5-year property, which is also known as tangible personal property, that carries a rate, an ordinary income tax rate of basically just taxed your ordinary income tax rate, unfortunately.
Or what you can do is, instead of selling it and taking proceeds, you could potentially do a 1031 exchange and push and keep on deferring and deferring and deferring.
Absolutely. Yeah. You could do that. But if you just sell it in an outright sale, you will have depreciation recapture. Okay, got it. And in this year is the last year for bonus depreciation. Is that accurate? Or Yep. So in 2022 is the last year for 100% bonus depreciation. In 2023, it's going to start to phase out 20% per year until it's phased out completely. So in 2023, you're only going to have 80% bonus depreciation. In 2024, it's only going to be 60%. And just to clarify what that means, if you buy a property, you place into service this year in 2022, you could take 100% bonus depreciation on that 5 and 15-year property that we're talking about. In 2023, if you buy a property in 2023 and you place into service in 2023, you're only going to take 80% bonus depreciation on that amount in the first year.
Yeah, no, this is good. I have a client right now, a client friend, whatever. He's selling a company, and he had like phantom shares of stock. So he says, he was explaining to me that it's going to be taxed as ordinary income. But this strategy, he could go out and buy a $10 million building and do a cost segregation, and this would work in that theory fairly well. Okay.
Right.
So yeah, it's advantageous to do it this year to maximize the bonus depreciation, or he's going to get a little bit of a haircut in 2023. That's what he can do. But so essentially, knowing this strategy, if his income, let's say is going to be $3 million, he could go out and buy a X amount of property. You could almost reverse engineer it, right? I mean, and know that you could offset all your taxes potentially.
Yeah, if you use the rule of thumb, 20 to 30%, you'll be able to tell, how much you're going to be able to take a property and say it's a $1 million property. You're going to say, I can get anywhere between $200,000 and $300,000 of bonus depreciation out of this. That would essentially offset part of your income. So you can back into this. Although I'd recommend, if you're seriously considering a property and you have a specific number in mind, getting an estimate from the cost segregation company on that specific property so you can get a more accurate read on what amount that specific property can generate for you.
Yeah, I think this is just so important, like kind of what we're doing right now, because it's like, people, you can figure out how to avoid paying a lot in taxes, and a lot of people just they don't get the right people on their team. And going back to the book, Who Not How, this is a perfect example, because I've been referencing that book. It's the who, not the how, guys. So that's a good side note there, and great information for people out there. Look, guys, if you're not buying real estate now, you should be. So
you're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. I hope this encourages you to look, because not only is there cash flow, appreciation, there's depreciation, right? There's so many advantages of real estate, but I think a lot of people overlook the whole tax component, which is in my mind, one of the biggest components of it all, especially if you're a high wage earner. This is where you should, it's a shame to see people paying 40% of their gross wages into taxes when they don't really need to, if they would study these systems and get the right people on their team. I don't know why people don't. And I guess that's why I have this podcast to bring guests like yourself on so we can dive into these topics. Also, guys, everybody, if you like what we're talking about, at the end of February, Thomas and his team are putting on a conference, and you can get information there at taxandlegalsummit.com, taxandlegalsummit.com. I'll link below. I would recommend, if you guys are interested in saving money and keeping more money in your pocket, this would probably be the event to go to. They're going to discuss short-term rental loophole, the reps status, which is a real estate professional status, passive losses, cost segregation studies, 1031 exchanges, self-directed retirement accounts, entity structuring, estate planning, and much more. So sounds like an event that I'd like to attend. But let's dive in here a little bit more, kind of pick your brain, because we're diving deep today. Entity structuring. And everybody's situation is different. This is just educational purposes. I would like to, speak to a consultant on your scenario, but from a high level perspective, if you're holding real estate for rental purposes, the ownership structure versus maybe a flipping business would be different. What are some of the kind of talking points we wanted to kind of discuss on this part?
Right. So I kind of break down the two most important concepts. Well, the most important thing I could tell a rental real estate investor: if you are intending to own a rental real estate, so you're going to rent it out to other people, you're going to want to not hold it. You never want to put that into an S corporation. There's one exception to that, what I'm not going to today, but avoid S corporations for rental real estate. If you do that, I promise I probably just saved you a ton of money and headaches down the line. So just avoid S corporations and rental real estate. The only time you really want to use an S corporation for real estate investors is going to be if you're a fix and flipper, or if you're a wholesaler. When you fix and flip real estate, the income you make from that, the profits are taxed at your ordinary income tax rates and are usually going to be subject to the self-employment tax. If you do these through an S corporation, you're going to be able to mitigate your exposure to the self-employment tax by paying yourself a wage through the S corporation and not taking the entire amount in profits. The same can be said for real estate agents, brokers, and other types of active businesses. But for rental real estate, avoid the S corporations. For rental real estate, you're typically going to want to look at putting it into a single member LLC that's disregarded for tax purposes if you're the sole owner. In that case, it's going to be reported directly on your Form 1040, your individual tax return. Or if you're buying with others, a partnership structure is going to be appropriate. So those are the two entity structures that you're going to want to look at as a rental real estate investor. And you can get fancy. There's different ways and different structures within that, but just know that if you're using a single member LLC or a partnership for rental real estate, you're going to be you're generally going to be in the clear. And if you're using it, if you're fix and flipping properties, you're wholesaling, looking at an S corporation. That's kind of the best advice I have in a nutshell without going too deep into it.
Got it. That's awesome. Now, is there a way? So a lot of investors come to me and they go, Beau, I got 6 loans in my name. They're agent, Fannie Mae, non-owner occupied loans, and I'm having trouble. Right, I'm having trouble getting more loans because of my DTI requirements. Then what I do is I do these DSCR loans, so it's not based on tax. We don't need tax returns. It's based on the cash flow of the property and credit score. It's simple. So what I usually do is take those 5 properties and put them into they put them into an entity of their choice, and then it's now in the business entity's name off of their credit report. My question to you, because I was diving deep on this with a client or a prospect candidate, is there an entity structure that you can actually leave the rent cash flows in the account. Like let's just say a holding company was like an LLC, and then there was a management company that managed an entity management company, and you didn't take any of those distributions for a few years and you just let it accrue there. Do you have to, is there a way that if there's no distributions taken, does that have to trickle down to your personal returns with the K1 if you don't take distributions?
So in most entities, whether it be a partnership or a single member LLC, which is traditionally where it's held, it's all going to flow through to your tax return, regardless of whether the income is going to flow through to your tax return, regardless of whether or not you take the money out or leave it in the entity. There's no way around it. You get taxed on the income that year, unfortunately. Now with C corporations, you can do that. C corporations, sometimes they call it a blocker corporation, because you put your investments in the C corporation and it would get taxed at the C corporate level, with C corp level, which is 21%, and not hit your personal tax return. So you can let the income accumulate in that entity. However, there are a lot of complexities when dealing with C corporations that don't come when you're dealing with these other entities. And with a C corporation, you might be at risk of having it being considered a personal holding company if a certain percentage of your asset, a certain percentage of the income from the C corporation is generated from passive income, which rental real estate is generally considered. So unfortunately, there's no real easy way to avoid paying tax on the income that you generate from these types of activities.
Yeah, no, I understand, Panda. I was just wondering, because a lot of people, their goal to do this is to move it out of their name so they can open up more bandwidth in their personal name.
Gotcha.
And then they know that it's going to eventually hit their tax returns. And then the conventional underwriter is going to go, well, what's this income? And let's open this up and how that's all going to be construed, and to navigate that. See, I don't really get involved in the conventional loans. I just do all the investor loans. Right. But everybody's situation is different. But I think what you can take away from this conversation is there's a lot of things that we all need to know and learn. And so that's probably why you want to get a good CPA on your team if you're investing in real estate or you're a business owner, so forth. For a business startup, I know this might not be your forte, but for a business startup, like if you bought a franchise, for example, our startup costs, you can't take, like if I bought a franchise and I paid, I don't know, a $50,000 franchise fee for that franchise in that particular year. Do you know if I can't take that, I can't write it off on year one for a startup business? Do I have to do it over 5 years? Is that accurate? Or
yeah, so for startup expenses, the way it works is you can deduct up to $5,000 of your startup expenses in the first year that you start up your business, as long as your startup expenses are less than $50,000. If they exceed $50,000, that $5,000 deduction you can take in the first year starts getting phased out. I forgot the exact phase out, but it gets phased out for like every dollar above the $50,000. So to answer your question, it is possible to do that. Now with franchise fees specifically, I vaguely remember going through this with a client, and if I recall correctly, don't hold me to this one, but if I recall correctly, the franchise fee would not be considered an operating expense. Instead, it would be capitalized as an asset, as an intangible asset for the company, and it would be amortized over the course of the life of the franchise fee. I'm not a franchise expert, so I don't know that offhand. Yeah,
no, I was just curious because a lot of my listeners also own businesses, and but if for example, and you might not know this, and we're getting too in the weeds, so I'm not even going to ask this question. but essentially, an existing business that I have bought a franchise to expand their existing business. I think if my thought process is that I probably could take that whole as a write-off, since it was an existing business buying a franchise to expand. But I don't know. I would have to consult with you probably to get in the weeds with that one.
Yeah, we would need to go into a little bit more details and to get all the facts and circumstances out on the table to properly take a look at it.
But I hope everybody listening gets it. Like, there's a lot of moving parts for all this. That's why you need experts, and you should consult an expert for your unique situation. I always emphasize that to people that, listen, this is education. Go talk to people about your specific needs and wants. Can you talk a little bit about the real estate professional, reps? And I heard that potentially that California, if you live in California, might not recognize the real estate professional status. Is that accurate?
Yeah. So I'll break this down. So the real estate professional status, what it allows you to do is if you work full-time in a real property trader business, then you're able to turn your losses from your rental real estate non-passive. And when that happens, the losses from your long-term rental real estate can offset your W-2 income or your active business income. So that's kind of what the real estate professional does for you, the benefits of it. To actually achieve the real estate professional status, you must spend more than 750 hours in a real property trader business. Kind of give a quick overview of what those are. Agents, brokers, fix and flippers, people in construction, developers, rental real estate owners, property managers. Those are typically real property traders or business, and it must represent your more than half of your total working time. So if you're working a full-time W-2 job, or you're working in a full-time business, it might not be possible for you to achieve the real estate professional status because, again, you have to spend more than 750 hours in a real property trader business, and it must represent more than 50% of your total working time. So if you're working a full-time W-2 job, and that's usually going to be considered around 2,000 hours by the IRS, you're going to need to work around 2,001 hours in your real property trader business to qualify. And that would be about over 80 hours a week, every single week for the entire year. So that's kind of how to qualify as a real estate professional in a nutshell. Now, for California specifically, they do not recognize the real estate professional status at the state level. So if you're a California state resident, what's going to end up happening is if you qualify as a real estate professional, you can take the losses from your rental properties against your non-passive income or against your active income at the federal level, but at the state level, your losses will still be passive and they will not offset your active income on the California state tax return, unfortunately.
That's why I live in Nevada. Okay, last question, I promise. Okay, let's talking about a syndication. So we have the general partners and we have limited partners. Limited partner invests in a syndication, and they're a doctor, let's just say, right, for this case in point. They buy a 500 unit multifamily property and they do a cost segregation study, and then they get the limited partner that invested $200,000 in the syndication gets a K1 right at the end of the year, and now they have a loss, right, a paper loss.
Yep.
But if they're a wage earner, they're not going to get the same advantages as maybe a real estate professional that invested as a limited partner.
That's
in
correct.
That deal. Okay.
Yep. So the way it works, if you're a limited partner in a syndication, your losses are automatically going to be considered passive by the very nature of you being a limited partner. So in that case, if you made $1 million as a doctor and you had a $200,000 loss passed through to you on a K1, unfortunately, that $200,000 will not help you offset your $1 million in income that you received as a doctor. There is one case when this could occur. And let's say that you are a real estate professional, right? Or maybe your spouse is a real estate professional and you have your own active portfolio. So you own your own portfolio of rentals. You're already qualified as a real estate professional. You would make a grouping election on your tax return to treat all of your rental properties, all your rental activities as one activity. And when you do that, you're going to group in that limited partnership interest as well into that group, making the entire activity non-passive. But again, in order to do that, you would need to qualify as a real estate professional. You need to have your own rental portfolio, and then you'd have to group all your rentals together. And that's pretty much the case when where a limited partnership interest would be able to be considered non-passive.
Awesome. Well, you answered a good amount of my questions today, and I kept my word. I'm not going to ask you any more today, maybe in a future conversation. Everybody, I hope you got a lot of value out of this. I mean, I think you could really see the importance of why you really need a good tax strategy session, because there's a lot that you need to know, or at least get the right person that's going to tell you what you should be looking to do. Because, it's the difference in paying. It's not about making more money. It's about keeping more money. And I think that's the real principle here. The tax piece is such a big part that people often overlook. And I think, like what we talked about, you can actually reverse engineer every year. And, even if the market goes up or down, and I'm having a huge taxable equation that's probably going to happen this year, a taxable event, you can look and strategically talk to your cost segregation company. They could say, yes, if you bought that building, this is what it would look like. And then you go speak with Thomas, and Thomas says, yeah, this is what it would look like, based on the scenario you're giving me. So that is very useful, very useful. So guys, taxandlegalsummit.com. And is there any other things you want to announce for that event? Or
we're going to be going through real estate professional status and short-term rentals in depth during that conference. So if anybody's interested in learning more about that, definitely attend if you can. It's a free event, so no problem with attending and learning about that if you can.
That's awesome. And where can people follow you? Do you have your own website, or where do you want them to go to the main website, or what's the?
Yeah, so I think the best place to probably get in touch with me is probably on Facebook, believe it or not. And so we have a free Facebook group called Tax Smart Investors. If you just search Tax Smart Investors on Facebook, you'll be able to find it. You can join that group. We have conversations with our members about topics like the short-term rental strategy or real estate professional status, cost seg, you name it, in that group pretty much on a daily basis. So.
Yeah, I joined that group. That's why I really started getting educated on all this stuff, even more so. And as a real estate professional, because I'm a real estate broker and I'm an investor and I qualify, there's huge advantages to it. So everybody, I would suggest you jump in the group. I'll put a link to the Facebook group in the show, in the YouTube notes. And as always, thank you guys for listening. Please like, subscribe, and share this YouTube video with your colleagues and stuff. Help me grow this channel so I can bring on more amazing guests like Thomas who can educate us, and so we can get better strategies, create more wealth, keep more wealth, and keep going. So anyways, thanks so much, Thomas.
And thanks for having me.
All right.